There's a gap in the mortgage market right now that has nothing to do with your credit score, nothing to do with your down payment, nothing to do with the Fed. It is about 0.3% wide. It comes out of your pocket every single month, and almost nobody is talking about it. Let me show you where it is hiding. I'm Ron Siegel, Certified Liability Advisor, helping families build wealth through strategic debt management. This is your weekend update for the week of July 31st, 2026. Where rates close. The markets are closed for the week, so these are final numbers. The 30-year conventional finished at 6.83%. The 30-year jumbo at 6.91%, the 30-year FHA at 6.34%, and the 30-year VA at 6.36%. These are national averages from Mortgage News Daily, not an offer to lend. Here's the part worth knowing. That 6.83% is basically sitting on the long-term high of 6.85%, which we hit back on July 23rd. So we are right back at the top. The 10-year Treasury closed at 4.736%. Last week, it was 4.69%. It was a bumpy week that went nowhere. Now think about how we got here, because the story is stranger than the numbers. The week started well. Sunday brought news of a pause in fighting in Iran. Oil dropped. Rates followed it down. That good feeling held all the way into Wednesday. Then the Fed spoke. And here's what most people missed. Before that meeting, the futures market put a 1 in 3 chance on the Fed raising rates this week. Not cutting, raising. They did not raise. That should have been good news for the mortgage rate. For about an hour it was. Then the press conference started and the bond market sold off hard for the entire hour it lasted. The moment the press conference ended, the selling stopped. So we finished the week almost exactly where we started it after a very loud trip to nowhere. The 0.3% nobody explains to you. Now here's the part I promised you. Your mortgage rate does not come from the Fed. It follows the 10-year Treasury. And there's always a gap between those two numbers because mortgage carries a risk. Because a mortgage carries risks. A Treasury bond does not. People move, people refinance, people pay off early. Investors charge for that risk. Over the long run, that gap is averaged about 1.79%. This week it closed at 2.09%. That's about 0.3% wider than normal. In plain terms, if that gap simply went back to its historical average and the 10-year Treasury did not move 1 basis point, the 30-year fixed would be sitting near 6.53% instead of 6.83%. No Fed cut, no new economic report, just a return to normal. Why is it so wide? Because when nobody is sure which direction rates are heading, investors charge more to take the risk. When the picture settles, the gap narrows and rates come down on their own. That's why waiting on the Fed is the wrong thing to watch. This is the number to watch. 3 members said no. The Fed met on July 28th and 29th and held. 3 members voted against it. Beth Hammack of the Cleveland Fed said inflation has been too high for too long. Fair enough. But in the same set of comments, she said demand was too strong and then said people are struggling and cannot buy things. Those two ideas do not live in the same house. Lori Logan of the Dallas Fed said prices are still rising too quickly. Neil Kashkari, the Minneapolis Fed, was the most measured of the 3. His concern is that we have had one supply shock after another. First Ukraine, then trade disputes, and now Iran. When they stack up back to back, higher prices start to feel permanent. The inflation news was better than headlines. Here's what the reports actually said. June core PCE, the inflation measure the Fed watches most closely, rose 0.1% for the month. The forecast was 0.2%. That was the smallest monthly increase in 15 months. The 3-month pace came in at 2.89%, the first reading below 3% all year. Year over year, it is still 3.29%, and that is what keeps the Fed cautious. Shelter, the housing piece of inflation, rose just 0.2% for the month. We have waited 2 full years for that. And the Dallas Fed trimmed mean, which strips out the wild swings in both directions, came in at 1.4% for the month. The month before that, it was 2.7%. That is real improvement. There is one more piece that has not landed yet. Starting with the August report, the way investment management fees get counted inside the inflation number is being adjusted. Those fees have been adding about 0.4% to the yearly reading. We will not see it until September. When it lands, it could move that number from 3.3% down toward 2.9%. What this means at your kitchen table. Economic growth came in at 1.5% for the second quarter, down from 2.1%. Underneath the headline, private demand grew at 3.9% pace. But look at who's doing the spending. Personal income rose 0.2% in June. Spending rose 0.3%. When you spend more than you earn, something has to give. The savings rate fell to 2.7%. Americans are covering that gap with credit, and credit card debt is the most expensive money in your household. Here's one more number you should hear. The May home price reports showed prices are still rising, but slower than inflation. So if you're sitting on the sidelines waiting for your future home to get cheaper, understand what is actually happening. Prices are inching up while your dollars buy less. Waiting is not free. Jobs are holding up. First-time unemployment filings rose by 9,000 to 197,000, which is still low. Consumer confidence in at 55.2, better than the 54 that was expected. Oil and what comes next. Oil finished the week near $85.78 a barrel after sitting around $68 in June. That's a move of nearly $18 in about 6 weeks. You feel it at the pump now, and it shows up in the inflation reports later this year. Japan also stepped in this week to defend its currency, and that selling spilled into our treasury market on Friday. So what happens from here? The 10-year yield has been stuck in a range roughly between 4.2% and 4.8%. At 4.736%, we closed near the top of that range, not the bottom. A real de-escalation in the Middle East would push oil lower and pull rates down with it. Same story with Ukraine. Until then, expect big swings in both directions. This market does not drift. It jumps. Featured this week, we put 4 resources for you this week, and there are several more posted beyond these. Number 1, 4 ways to turn your home equity into cash. Pick the wrong one and it costs you. Number 2, the home buying costs nobody warned you about until the bills start arriving. Number 3, the best colleges don't rank themselves. Why do you let them rank you? Number 4, your business is growing, but your money isn't. 10 mid-year fixes that protect profit. You'll find all of them on the right side of your screen or below the video, depending on the device you're using. If your tax return does not tell your whole story, we keep a selection of loan programs for people whose tax returns do not show the full picture of what they actually earn and can comfortably repay. Here's the one I want to highlight this week. Employers everywhere, and hospitals in particular, are moving people from W-2 to 1099. Same job, same desk, same paycheck. Then you go to buy a home and the bank tells you to wait 2 years. You do not have to wait 2 years. I break down the loan that solves this, and it is available right now. The details are at rsrlinks.com/W2-1099. That's rsrlinks.com/W2-1099. If you are a nurse, a physician, a therapist, or a technician who got that letter this year, that link is the whole conversation. Strategy beats rate always. Debt Done Date. One more thing and it's free. It's called Debt Done Date, and you'll find it at rsrlinks.com/DDD. That's rsrlinks.com/DDD. You enter every debt you carry, your mortgage, auto loans, student loans, credit cards, and any unsecured debt. We then show you several different ways to strategically pay all of it off and the exact date each path gets to you to zero. Most people have never seen their debt laid out in a single page with a finish line attached to it. It changes how you think about every dollar. Take 10 minutes this weekend and run yours. Next week on the calendar, next week is Jobs Week. And again, all times are Pacific time. Monday brings ISM Manufacturing at 7 a.m. Tuesday brings job openings at 7 a.m. against a prior reading of 7.59 million. Wednesday brings private payrolls at 5:15 with 98,000 the month before, then ISM services at 7 a.m. Thursday brings jobless claims at 5:30 a.m. And Friday's the big one, the July jobs report at 5:30 a.m. The forecast is 91,000 jobs, up from 57,000 last month. with unemployment expected to move from 4.2% to 4.3%. Oil prices stay in the picture all week too. If those job numbers come in soft, mortgage rates tend to follow them down. Everything I mentioned today, the featured articles, the loan programs, and the tools is on the right side of your screen or below the video, depending on the device you're using. That's the weekend update. We appreciate you listening, and we'll speak to you again next week.